All right, today we're going to tackle something that honestly affects pretty much every big money decision you'll ever make: interest rates. And understanding how they work isn't just for Wall Street types. It's a skill that can literally save you thousands, even tens of thousands of dollars.
So, are you thinking about buying a house? Or maybe getting a new car? Or dealing with student loans? You see that sticker price, but that's just the start. The real question you gotta ask is, what is this really gonna cost me in the long run? The answer to that always comes down to one powerful little number.
Okay, let's just break this down. What even is interest? At its heart, it's just the cost of borrowing money. Think of it like this: you're basically renting cash from a bank, and the interest is the rental fee you pay for using it. And you'll usually see it listed as an annual percentage rate, or APR.
You know, the best way to really get this stuff is to see it in action. So let's walk through a story, one that a lot of us will go through: buying a home. We're going to follow the money and see exactly where every single dollar goes.
Okay, so here's the scenario. You find a house for $300,000. You've saved up a great down payment, $60,000, which means you need to borrow $240,000. The bank gives you a 30-year loan at a 7% interest rate. Seems straightforward enough, right? But what does that 7% really mean for your bank account?
Okay, this is where it gets wild. We're going to plug these numbers in and see what that final bill actually looks like over those 30 years. And, well, you might want to brace yourself for this one. So you run the numbers and your monthly mortgage payment comes out to about $1,597. Okay, that's the bill you'll be paying every single month for the next 3 decades.
But here's the crazy part. Take that monthly payment and multiply it by 360 months, which is 30 years, right? The grand total you pay back isn't $240,000. Nope. Over the life of the loan, you'll actually pay the bank a staggering total of around $575,000.
Whoa, wait a second. Let that sink in. You borrowed $240,000, but you're paying back more than double that. So where in the world did all that extra cash go? How much of that total is just the fee for renting the bank's money? And here it is. The answer is $335,000. Yeah, you heard me right. The interest alone, the fee for borrowing the money, is more than the original loan itself. That's the unbelievable, relentless power of interest piling up over time. Okay, I know that number is huge, and it can feel a little defeating, but hang on, don't panic. This is actually where you get to take back control, because a tiny, tiny change in that interest rate can end up saving you an absolute fortune. Let's see how. Let's say you did a little shopping around. You found a lender offering a loan at 6.5% instead of 7. Just half a percent difference? Well, look at this. Your monthly payment drops by $80. Now, $80 a month might not sound like a life-changing amount of money, but just wait. Because over those 30 years, that $80 a month adds up to almost $29,000. 29 grand. That is a huge chunk of cash that stays in your pocket, not the bank's, all because of half a percentage point. So that leads to the obvious question, right? Where do these rates even come from? Are they just pulled out of thin air? Nope, not at all. There are actually 3 main things that lenders are looking at.
Okay, first and foremost, your credit score. It's pretty simple. The higher your score, the more reliable you look and the better rate you're going to get. Then there's the loan term. Think about it from the bank's perspective. A 15-year loan is way less risky for them than a 30-year one, so you'll almost always get a lower rate for a shorter term. And finally, there's the big picture, the whole economy. When you hear about central banks raising or lowering their rates, well, that trickles down and affects what every lender can offer you.
But wait, there's one more piece to this puzzle. It's kind of like the secret villain in this story, and it's called compound interest. And when you're in debt, let me tell you, it is definitely not your friend.
Here's the deal with that mortgage. Every single month, the bank calculates the interest you owe on your remaining balance. Then they add it to the total. So the next month, you're not just paying interest on the money you borrowed, you're paying interest on last month's interest. It's the snowball effect. You're paying interest on top of interest. And that's exactly how that bill got so massive over 30 years.
Look, the whole point of showing you these big, scary numbers isn't to freak you out. It's the complete opposite. It's to show you that this knowledge is your superpower. Understanding this stuff puts you in control, in the driver's seat. And you gotta remember, this isn't just about mortgages. This is the same game being played with your car loan, your student loans, personal loans, and oh boy, especially with credit cards. The only time this whole thing works in your favor is with savings and investments. That's when your money starts making money for you.
So if you remember just one thing from all of this, let it be this. Before you sign on the dotted line for any loan, take 5 minutes. Go online, find an interest rate calculator, and plug in the numbers. See the real cost for yourself. It is the single most powerful financial move you can make.
And I'll just leave you with this. We saw how finding a rate that was just 0.5% better could save you almost $29,000. So, the real question is, now that you know how this all works, what would you do with an extra 29 grand?